Hello friends. After the recent Tata Motors demerger into TMPV for its passenger vehicles and TMCV for its commercial vehicles, something really interesting happened. TMPV posted a profit, but its share price started dropping. TMCV posted a loss, but its share price started increasing. Now this is baffling, right? And you might be wondering why I'm dealing with this subject in the IFRS series. Let's get down to the reasons. Let's break it down with numbers and IFRS rules and find out why all this happened. If you're an audit professional, if you're an investor, or if you're looking for just knowledge into the share market and IFRS, this video is for you. Hi, my name is Pratheej and welcome to Deep Dive into IFRS. For the second quarter of FY 25-26, TMPV posted a profit of around 76,000 crores. But here's the twist. This was not actual profit. This was because of a notional gain of 82,000 crores because of accounting requirements as per IFRS 5, IND AS 10, IFRS 13 and Appendix C of IFRS 3. Now, before getting into that, you guys have to know what is a common control transaction. In times of a business combination or business reorganization as per IFRS, if both before the event and after the event, the same parties control all the entities, then that is called a common control transaction. And that is just what happened here. So, because it's a common control transaction, as per the IFRS I've mentioned earlier, that is IFRS 5, IND AS 10, IFRS 13 and Appendix C of IFRS 3, the assets have to be measured at fair value. So if you see, before the demerger, TMCV had assets worth 38,000 crores in its balance sheet, and these were at historical cost or written down value. After the demerger, as this had to be revalued, when the valuation happened, the actual fair value came to about 1,20,000 crores. So 1,20,000 crores minus 38,000 crores, that comes to around 82,000 crores. And this, because of IFRS accounting requirements, has to be shown as a profit in profit and loss account. So this offset the actual losses incurred by TMPV, which was around 6,000 crores. So if we move past this one-off gain, mainly because of IFRS accounting requirements, the real picture starts to emerge. Operationally, all was not well with TMPV. Consolidated revenue fell by around 14%, mainly because of global disruptions and a cyber attack at Jaguar Land Rover. The EBIT came down to 0.2% and the EBITDA margin slipped to 5.8%. Now the market investors and the analysts, they dug deeper, found out all these reasons, and after all these came to light, the share prices started dropping. So this is a classic example where if we only go by net profits, we might be fooled. We always have to dig deeper. But you may think that IFRS is misleading people because of this. But that is not the case. IFRS always requires you to give proper disclosures with respect to risks. If you had taken a look at the TMPV's notes to accounts, all these operational risks, the challenges they are facing and the global disruptions were mentioned. So before you invest in any share, any stock, you not only have to go with the profits, you have to look at the entire financials, you have to dissect it very deep and only then make an informed decision whether to invest in that stock or not. Now let's move on to TMCV. For quarter 2, TMCV posted a loss of around 867 crores. But again, as we saw earlier, let's not make any decisions at first glance. If you dig deeper, you will see the real reason why the share price started increasing. TMCV had a stake in, or rather an investment in, Tata Capital. And under IFRS 9, there is something called mark to market, which requires that every quarter you have to value your investments and you have to show the market value in your balance sheet. And unfortunately for this particular quarter, the value of Tata Capital dropped. And because of this mark to market thing under IFRS 9, TMCV had to show a loss of around 1,000 crore. This is only a paper loss. No money actually left the company. So this 1,000 crore mark to market frictional loss had to be shown in the financials, in the books of accounts. And because of this, the actual profit of around 1,200 crores of TMCV became a loss of 867 crores. But if you look operationally, actually it was very good. The business was improving and the return on capital employed was around 45%. Again, the market, the investors and the analysts dug deeper. They found out that it is actually a thriving business, and even though because of IFRS requirements, the financials show a loss of around 800 crores, the business is good. So it's safe to invest. And that is the reason why the share prices started increasing. So what's the big lesson here? See, IFRS represents economic reality, but it also means that one-time losses or gains because of demerger accounting or revaluation of investments, these can headline numbers and give you a notional profit or a notional loss. So while you're investing, do not just go by numbers at the first glance. Always dig deeper, read the notes, analyze it, try to understand these concepts. If you're not in a position to understand all this, please consult an expert before you go in for an investment. I hope this video was useful to you guys. Till I see you in the next episode, thank you for your valuable time.